One question I get constantly from people is asking if there is a way that they can draw equity out of their investment property and use that for repairs or acquiring another property. Today, I'm going to show you a few options and really focus in on one of them on ways of accessing that equity that you may have in an investment property. One of the options that is my favorite is an all-in-one loan. This is a first position HELOC that has some really cool features with it. It's an awesome product. If you are not familiar with it, please click on the link here. I just did a webinar on introducing the all-in-one to you. The other option is doing a second lien home equity line of credit. Most local credit unions and banks will not do these on investment properties. They are hard to find. They're kind of a pain in the rear, and they limit generally how high of a loan to value you can go. Now, the benefit on the second position HELOC is you get to keep your first mortgage in place that you have. And if you've had that mortgage for a year or so or more, you probably have a really good, awesome rate. The all-in-one, obviously being a first position HELOC, would replace whatever current mortgage you have on there. The one I want to talk about today, and the one that is a new product for us to be able to offer to our clients, is a fixed rate second mortgage. And this is a fully amortizing loan, meaning that when you make your monthly payment, you're going to be paying principal and interest so that the loan balance works its way down. So huge benefit being able to keep your current first mortgage. You get to choose the term of the loan on this. You could do 5, 10, 15, 25, or 30 years. The 30-year is pretty cool that you can do that. We can go all the way up to 90% CLTV. That's combined loan to value. What that means is that if you have $1 million investment property, you owe 800,000 to the first mortgage, or 80%. We can do another 10% on this second mortgage and go all the way up to 900,000. So you'd have an $800,000 first mortgage and a $100,000 second mortgage. That's pretty awesome to be able to go up that high on the loan to value. We can go as low as 640 on the credit score, and that's pretty low. Just be aware that the lower the credit score goes, the higher the rate is going to move, and you won't be able to go all the way up to 90% on the combined loan to value. Loan amounts, this is awesome. You can go anywhere from 25,000 to 500,000. And I would say this, just kind of a rule of thumb for me, is that if somebody's coming looking for a $25,000 to $50,000 home equity line of credit or cash out on their investment property, I think the HELOC is a better option than doing the fixed mortgage. The closing cost will be a little bit less, and that's a good way to go. But if you start moving into the larger amounts, this fully amortized loan is really good. It's a great loan to consider. A couple of notes here. Rates are right now anywhere from 5 to 9%. It just depends on so many different factors. It's hard to say where your rate's going to be at unless we can talk to you on your specific situation. This is good for single family homes, townhomes, condos, as long as they are warrantable condos. It is good on duplexes, but triplexes and fourplexes or higher are not eligible. Also, if the property has been listed for sale by you in the last 12 months, it will not be eligible. There's a few other things, but we can talk about those on a case-by-case basis. Let me give you an update on rates, where we're at. Inflation continues to be the concern here. Rates have got worse, but over the last 2 days, we've had a nice little bounce or recovery. Who knows how long this is going to last here. We have some room for improvement, moving up to the 102.5 level. Again, reminder, as this chart moves down, rates are moving up. It's an inverse chart. A couple of comments we've had is that the New York Federal Reserve president there, he had a quote and said that a hard landing is inevitable. And he's referencing to what's going to be happening with all the raises on the Fed funds rates and what that will do to our economy. And I shared a video with you on the recession that I think is coming in the future, and that would be the result of the hard landing. We're still watching and seeing what's going to happen on the balance sheet runoff, or meaning the mortgage-backed securities, the mortgages that the Federal Reserve has bought in the past and they're holding on their balance sheet. They are going to start getting rid of those at some point, and that could have a negative effect on our mortgage rate. Just always keep remembering, inflation is the enemy of mortgage rates. Now, I'll put a link up here to the video I did on the recession and the indicators or predictors of a recession, one of which is the difference between the 10-year and 2-year Treasury yield. And when it turns negative, a recession follows. And that has been a really solid pattern in history. I've only shown back here to 1998, but you can see anytime it turns negative or red, you can see that gray bar where a recession happens. And we are at 0.03 today, and we fully expect this to turn negative, which will become an indicator that in a year or even 2 years, recession will be coming. Going negative doesn't mean the recession comes immediately. It just means it's on the horizon for a year or 2 years out. Again, my name's Miles Pitcher. I own Superior Lending, loan officer here in Utah. Let me know if you have any questions on things. Even though I'm in Utah, if I can't help you with the state that you're in, I have lots of great contacts, legit local lenders in your area who can help you. Have a great week. We'll talk to you later.